Well, big brand retailers are set to face tariff exposure and shifting consumer behavior, but my next guest says Walmart is positioned well for the potential impact. For more, let's welcome in now David Bellinger, Mizuho America's Director and Senior Analyst. David, it is great to see you. So I think you know where I have to start, David. We've got to talk tariffs. I would imagine, David, your clients are asking you all kinds of questions. These Trump tariffs, what do they mean for the retail sector? What do they mean for the retail industry? What are the ripple effects we have to think about as investors? What are you telling them, David?
Hey, Jess, thanks for having me back on. And yes, this is a widespread issue. We've gotten a lot of questions over the past week or two about just what do tariffs mean here. And it's definitely a negative, right? You've got all this noise out there. Prices are clearly going up. But right now, we're hearing a lot that consumer sentiment has been weakening. And data from January, February was pretty mixed. It was somewhat negative. You also had a lapping of leap day last year. So a lot of noise in the numbers. We think March got a little bit better and the start to April has been fine. Like we've seen some stabilization here, but there's just a lot of noise out there, potentially some panic buying on the part of the consumer and maybe some pull forward in demand, which just makes the picture a lot more unclear here. There's a lot of tariff exposure in the US. These are domestic retailers, but they do source a good deal amount of product from overseas, China, other parts of Southeast Asia. So we're not seeing companies overreact just yet. We're trying to work through all of these pieces as they come in, and there's just not a lot of clarity out there.
Uncertainty is definitely the word of the day, Data. I'm curious, though. I mean, when you look at retailers, do they look generally positioned to eat some of these costs, or no, they're going to pass it along to David and Josh? To your point, you look at the consumer sentiment surveys, it doesn't seem, like Dave, like consumers are they seem not in a great mood already. So I'm curious how much, if they do try to raise prices, what you think the reaction would be.
Yeah, there'll clearly be some demand destruction here. So prices go up, unit volumes tend to come down. And we haven't seen the prices get pushed through yet. The consumer is definitely aware of this, right? And talking to companies like Walmart, we were just at their investor day down in Dallas. It seems like they have the optionality not to push these through right away. And the bigger players, including them, Costco, Home Depot, Lowe's, they sort of have the optionality here. They can do it in a slow and measured way so as to not shock the consumer. But these companies are all wired to protect their margins, right? So you want to keep costs as low as possible while protecting your margin base. And that's definitely something for these larger scale players who can push back on vendors, maybe source from different countries outside of China, move their supply chains around quickly if needed to. And they try to make those guys absorb more of the cost. So me and you, we don't pay a 25% increase on a 25% tariff. Maybe it's halfway in the middle, and we absorb pieces here and there, and the consumer is able to eat this a little bit better than if there were no offsets in general.
Let's get to some specific picks, David. You mentioned Walmart. I saw that you initiated this one as an outperform, so you're a believer here. You told your clients, delivering the complete package. What do you mean by that, David?
Yeah, thanks for the question here. So we see multiple ways to win with Walmart. So the biggest piece, you've got this core business that's really benefited from consumer trade down. And a majority of the share gains that Walmart's picked up over the past year or two, they've been upper income consumers. So that's been pretty well documented. You've got the Walmart Plus program where consumers pay $98 a year. You've seen a lot of people step into that. We think they have about 20 million paying customers. Also, Walmart, this story has become really about the alternative revenue lines within the business. And those are advertising, membership, which you just mentioned, and marketplace. And that those are the fastest growing pieces of the business. And they also layer in the highest incremental margin rate. So just think of Walmart, $700 billion global retailer. Company has been around a 4% operating margin. We see a path to get well north of 5%. And it doesn't sound like a huge difference, but on that revenue base, there's massive EPS potential. So if you're talking about $2.55 or so at the midpoint of their guidance range this year, you could easily see Walmart be well north of $4 per share. Investors want to pay a premium for that. This is becoming more and more visible. And then one last piece here, you've also got what we think is somewhat of an overlooked Sam's Club business. It's very similar to Costco. We think they have about 30 million members, and those are powering a really nice, highly incremental margin into the overall mix of the business. So it's not just the core Walmart. They've got plenty of other drivers as well, and that's why we refer to it as the complete package here.
And David, you made a convincing case there, but before I pile in, how would you explain downside risks to this one?
Yeah, it's a good question. So everyone's going to be hit in some kind of a consumer slowdown, right? We do think Walmart is well insulated here. They've got the tariff offset, plus you've got more than 60% of the business relates to grocery consumables type items. So more non-discretionary. So you've got a good core base there. But if sales were to slow, they'll get hit like everyone else. We think they'll have relatively better numbers, but we frame the downside scenario for Walmart at about $75 per share. And that's as you get sales to slow a bit, but you've also got these margin offsets and these accretive pieces of the business that aren't fully tied to the macro, somewhat secular, just given their early stage growth stories.
So you like Walmart, David. Let's also talk about Costco. That one, you're lukewarm on that one. Looks like you had a neutral rating there. And it sounds like valuation is a concern for you.
Exactly. So a couple things here. Great company. We don't think it's a great stock just because of where it's this setup here. And you've got a consumer name trading at almost 50 times earnings. So that's a big number. Walmart's in the mid 30s, also a big number, but relatively better. And so Costco, incredible operator. Their execution has been nothing short of stellar in our view. You've got these mid-single digit consistent comp numbers each and every month. And no one's really putting that up across the consumer space. But our concerns here is they do have an ads business, very similar to Walmart, but we think management has a different intention here, where you won't see all of the upside flow through to the bottom line. And in quintessential fashion, Costco puts that upside back into the member experience. So lower prices, better rewards. And that's probably the right thing to do to protect your sales base. But we think investors are expecting a little more on the flow through. And then just the valuation piece. If you potentially have a business that's set up with all these investments to have a higher leverage point, what I mean by that is you need mid-single digit or high single digit sales in order to get margins higher. If you have that set up going into a potentially slowing macro environment, we just think that's difficult to underwrite 50 times earnings on.
And Dave, final ticker I want your take on, Target. Now that one you're neutral as well. So why are you on the sidelines there, David? And what would you need to see before getting more constructive?
Yeah, Target has massive upside potential here, right? You're talking about a stock in the mid 90s or so. Margins have been pressured. They've had slowing comp sales. We think that's a function somewhat of what Walmart has been doing with delivery and convenience and getting that customer who wants to order online. And then you've also had inventory shrink. So they have not fully fixed this. You still have a lot of product that's locked up in stores, and that's keeping a lid on the margin rate at this point. But what we'd like to see is discretionary is a big piece of this business. Almost half of the product base, half of the sales base leans more discretionary for Target. And that's where we haven't seen the recovery just yet. Apparel, home decor, electronics. So if you start to see a shift there, that'll definitely help the Target profit recovery story. But as we look at this today with all the tariffs flying around and about 50% of their products sourced overseas, we actually see some downside risk to near-term numbers for Target.
David, appreciate your time and those stock picks. Thank you.
Thanks, Josh.